Welcome back, guys, to your favorite place to be, hopefully, where we're going to be breaking down for you the Federal Reserve's PDF file that you can get online that is basically a summary of the economic projections. So thank you guys very much for tuning in. We're going to be basically breaking this down for you. So it's very important to remember, guys, that this meeting is very important because it shows where the projections are going for the rest of the year. Rather than just focusing on the times right this second, it gives us kind of an idea of where we can place certain ideas and what we think. That way we can kind of apply it to our portfolios, right? So let's jump into it, guys. So the first page is kind of just a summary. The PCE inflation rose from about 2.4 to 2.7. That means the inflation basically is worse than they thought. It's stickier, as the Federal Reserve likes to say. It's the confession to what it is that the rest of the report is going to fill our heads with, right? Exactly. That's exactly what it is. So we're going to jump down here to page 2. Now, this is the economic projections of Federal Reserve board members and Federal Reserve Bank presidents under the individual assumptions of projected appropriate monetary policy. So basically, in short, it's just basically an aggregate of data from all the Federal Reserve members that basically breaks down what is going to be the projections for certain things like inflation, unemployment, GDP growth, also where we see the funds rate going to be at the end of the year, which they're saying it's going to be the same, right? They're not going to leave things unchanged. And in fact, they even go as far to give us data where they think it's going to be by 2027 and 2028, which is basically, as we know, by looking at this, not a lot of room for money to become cheap again, right? They want to keep money very expensive because they don't want to spike inflation. They don't want to artificially print money to artificially pump the markets. That's kind of what this is suggesting right here by the 3.4% Federal Reserve's rate, federal funds rate. And then also it kind of goes to also show a couple other different things that we're gonna go in here is the PCE inflation. The line at the bottom left, the small bounce, is going to be stagnating above 2%, which breaks everything's fine narrative, right? That breaks that everything's fine simply because if we look at this, it basically suggests that the inflation is not likely going to go down, right? The inflation is actually going to stay high, or it's going to stay where it's at, which the general public has kind of accepted that these prices are where it's going to be currently at. If the general economy cannot take that much more inflation, okay? So that's kind of what these numbers are kind of in line with. The normal American can't take a lot much more inflation, or they're just going to basically not be able to service their debt, which we've already seen a record. We've seen a record explosion in like credit card debt, car rate repossessions, typical things that normal people have debt instruments tied to their name with. So let's see where we're at here. All right, so let's look at the dot plot right here. Should we skip this? Let's skip this. Here's the PCE inflation right here. So they're anticipating that inflation will cool into 2027, 2028, but they're a little bit unsure of what is going to be happening right here. All right, and the unemployment rate as well. They're kind of saying we don't know kind of where it's at right this second, but we can kind of think that in the future, the unemployment rate might go back down or kind of stay where it's at, right? Around this 4.4% unemployment rate. And here's a real change in GDP here that they're suggesting here is they're considering that in the long run, we're going to stabilize kind of somewhere around this a little over 2% growth in GDP. But right now, things are good. It kind of isolates and kind of takes the responsibility out of the Fed's hands to say, you know, everything's fine right now. We don't really need to cut rates to drive inflation. We're trying to help the Americans. But notice they're not really raising the rates either. They're not really, you know, the Fed members, they're not trying to raise the rates, because we also know as investors that the S&P, most of the companies on there are actually not driving growth. There's a handful of companies, AI, Apple, Nvidia. Other than that, it might be like 10 companies that's really like driving new growth into the S&P index. So we also know that also presents debt to companies that are not doing well. There's probably around 10%, I would go to guess, that are not or not going to be able to service their debt. And then also, if they raise the rates too aggressively, or they raise the rates really at all at this point, regional bank failures will resume, similarly to how we had with Silicon Bank and some of these other ones. Even though we can kind of think those were tied to crypto, but don't be so sure, right? They're not raising the rates, even though they probably should, right? They probably should raise the rates, nor are they cutting the rates to make money cheap again, to artificially pump the S&P, right? Or artificially pump the stock markets, or you know, the macro markets around the world. And let's see here too. Let's go in here. We did the inflation. We did the core PCE inflation. So they're anticipating inflation to kind of cool into next year. Yeah, next year is going to be great. We just got to get through this kind of year where we have this range where members of the Federal Reserve can't make up their mind on where they think the projections are going to be. That's why we have such a rounded or wide angle, or I'm sorry, a wide variance between these two troughs right here, right? The bottom and top. So let's jump down here to 4. So basically what we're doing here is we're going to be looking at the votes from the Federal Reserve to target level for the Federal Funds Reserve rate. And the target for 2026, based on these votes, is suggesting that the federal funds rate needs to stay kind of where it's at, right? Between this bound right here. It's why you see a concentration of votes right here. So this is the appropriate monetary policy they're voting on. And as we see, they're kind of trying to allude to next year. Hey, you know, next year, let's get through this year fine. Let's keep money expensive here now. But next year, depending on how things go with unemployment, with how, you know, we see if inflation cools, we'll see, you know, we have a lot of members voting towards maybe some rate cuts, right? And hence why back on this page that a lot of the median was sitting down here near the 3.1 level, with a range a little bit higher. And, you know, obviously, you know, we're looking at a median, so we can kind of assume that there is a circular narrative that the Fed and the Fed members are trying to propagate to us, right? Oh, we're going to keep the rates kind of where they're at now, but next year, and even the next year, we're even guaranteeing that there's not really that much of a likelihood like this year we're going to stay the same. We're going to kind of move into maybe this 3% target range, which is, you know, considerably lower in the scope of where we're currently at, right? Even though you know, these numbers, they tend to change. So here's a distribution of participants projected for the change in real GDP 2026 over the long run. So basically what it's saying here by the graph is that, you know, the American economy is doing fantastic, right? We're still getting GDP growth a little over 2%, right? And then even next year, we're going to be even going into a higher number. And then 2028 is going to be fantastic, right? That's kind of what it was saying up here, right? And, you know, and that's kind of the idea behind this, guys. They're trying to give us hopes that everything is okay, while everything under the hood is suggesting otherwise. Yeah, don't worry. By the end of this year, you know, GDP will pick up, unemployment will come down, inflation will cool, and we'll be right at that target level that the Fed has been talking about so notoriously over the last couple years. So here's a distribution of the unemployment rates. They're anticipating unemployment to kind of stay the same. However, they are not ruling out an increase, right? They're kind of saying, you know, unemployment's kind of at this 4.4% now. However, it might creep up to 4.5. A few people are putting it in the 4.6 range. And, here's the number of participants that are saying, hey, a lot of members are confident that they have unemployment under control. They're even more confident that next year, they're going to have it even more under control. And then 2 years from now, they're going to say, hey, that's the same level we're currently at. That's where we're staying, 4.4%. They're trying to make it seem like the projection numbers are in line with where we're currently at, to try to curb the idea that that inflation is going to cool, unemployment is going to just stay at this level. It's not going to get any higher. However, they're not dropping the interest rates. Therefore, how is the U.S. government going to service their debt that is now more than the entire budget of the military just on the interest alone? And then also, what is going to happen to the future, of course, the future of the economy, right? In the longer run, they're kind of saying the same thing. Yeah, this 4 to 4.3, 4.4 level, it's just normal. You guys just need to get over it. That's the unemployment rate forever. That's what it's going to be. They're literally projecting that multi-years out. So that's why this report's so important here, guys. So here's more on that. Let's kind of jump down here. Yeah, so that's the PCE inflation right there, right? And it's the same thing. They're saying that the inflation numbers are, the inflation numbers are going to be a little over 2%, right? We're going to be at this 2.5, 2.6% level. However, over the next 2 years, inflation's going to be, we're almost totally confident we can get this inflation under 2%. But a lot of people, guys, really aren't buying that, right? Because they keep saying that the wage growth in previous meetings is keeping up with inflation. However, we all know, guys, unless you're making, maybe your investments are 300% more. But when you go to the gas pump, when you go to, when you go out to eat at a restaurant, when you go and buy groceries, we know that the prices are in some cases 1 to 2, 300% higher. Obviously, gas and crude oil is back where we were at in 2022, where it spiked, right? Remember during COVID, we were all sitting at the gas pumps trying to figure out why it was almost double to fill up gas prices. Well, that's because the gas prices of crude oil has came up. And we obviously all know, guys, that, it has nothing to do with our own self-sufficiency in the crude oil. I mean, the U.S. is the largest producer of crude oil in the entire world. We outsurpass Saudi Arabia, Russia, but we also know that our production is not, the only thing that causes the prices to move. We know that around the world, the futures market on commodities will drive those prices higher, and that's exactly what we're kind of seeing shape up. So a lot of these, we're going to skip some of this stuff. This is uncertainty and risk projections. We're going to skip some of this stuff and just sum it up here. That the majority of the Fed members are trying to make it seem like we're going to keep money expensive. We're not going to raise banks to bankrupt the regional banks or to bankrupt the companies on the S&P that are about to not be able to service their debt. We're not going to increase the interest on the U.S. debt because it's already at a ceiling. It's more than the entire budget of the military alone in interest alone. But everything is great. Everything is good. We're still seeing strong GDP growth. The unemployment numbers did creep up. However, we're not really worried that they're going to keep creeping up. That's kind of what they're alluding to. So if you like this video, guys, drop it in the comments. I'm going to try to get this out here today. And, let me know, guys, what you think. And we'll talk to you soon. Take care.